Hi, welcome to Market in a Minute. This should be a really interesting week. And no, I'm not going to whistle past this graveyard. I do see some concerns, but hopefully everything turns out well and the market continue to advance. So this week, the Fed's going to come out and cut rates. We know that, but they're also going to kill off quantitative tightening. I think that's a major positive to kill that off. Microsoft, Meta, Google, Apple, and Amazon report. Okay, so this is only the majority of the Mag 7 and a big part of the S&P 500. So these reports are critical. And then Trump and Xi meet in South Korea. Hopefully that goes well. And then the markets are fully valued, but we have plenty of buy ideas. So the market itself looks expensive. A lot of these tech stocks look expensive, but we think we'll see continued rotation as rates come down and liquidity to the rest of the market gets restored, and the economy starts to improve for the rest of the stocks in the S&P 500. That could be very powerful, and we're starting to see that rotation occur already. So, market update. On Wednesday, the Fed's going to cut rates by a quarter of a point. So bring the rate down to 4%. We think they're going to 3.5 and maybe lower. And then they're going to shrink or stop the quantitative tightening. So they already shrunk the balance sheet from 9 trillion down to 6.6 trillion. And it's starting to hurt the plumbing of the overall financial system. Some areas of the financial system are just completely dry. So they need to lean off of that and let the liquidity get restored. So this has been concerning us for the last couple of weeks. So the quantitative tightening stopping is like having a big rate cut, not 25, maybe 50 or even 75. It's a big deal. So it's very positive. So on the earnings coming, so look for Wednesday for Microsoft, Meta, and Google, and then Thursday for Apple and Amazon. Uh, what we want to hear is more about the AI spending, what the plans are. That's so important for the overall markets. So spending, the capital spending to build out AI, extremely important. And then the revenues are getting from these data centers. The big risk is for the market because it's 48% in tech and tech related, is these five stocks are going to be reporting this week. We like Amazon. So Amazon came out and the rumor is that they're going to cut 30,000 jobs before they report on Thursday. We kind of find that a little bit odd, okay? But we do expect them to talk about their AI initiatives and be more efficient. So I'm not sure this is a negative or a positive. So generally cutting 30,000 jobs is perceived as a overall positive because they're cutting costs. But in a growth company, I'm not so sure that's a fantastic thing to be doing. But Amazon needs to become more efficient. So we're going to lean to the positive side. I like Amazon. I think Amazon is one of the more interesting of the Mag 7. And you can play it with AMZU. It's the 2X on Amazon. So we're currently invested in AMZU. The Trump Z meeting on Thursday, this is also critically important. So you got earnings, you got Z, you got the Fed cutting rates. So if that all goes well, we think the market probably continues to gravitate higher. But on our work, the market's fully valued on 2026 earnings. In fact, it's discounting the earnings maybe fully for 2026. So we think the market's about 8 months ahead of itself. So generally it discounts 6 months in advance. So we're about 8 months ahead of where the market should be in our opinion. But below that, there's a lot of interesting, really good names that we think we make a lot of money on as rates are cut. We get that rotation, so we move back to the early cycle stocks. So we're in late cycle, get the rate cuts, we move back to early cycle, the market broadens, and we can make some good money. I want to point this out. The Mag 7 chart here looks identical to the S&P 500. It broke the 20-day recently, came down, almost touched the 50-day, bounced up through the 20-day. That's exactly what the S&P 500 has done. So we want to be defensive as it breaks these moving averages and get out of the way of it well before it gets down to the 200-day or lower. Earnings. So some of the earnings that came out last week, I want to highlight some key thoughts. So Mobileye reported, and so did Tesla. So both are really interesting companies. We think Mobileye is set up as a really interesting stock here. So what they said was, as we go through the year, next year, they're going to see more and more business as these partnerships that they have really come together, and they get us to start reporting some revenue growth from these partnerships. So the taxi service that they're doing with Volkswagen and Lyft, that'll start to come into fruition as we get into the latter part of next year. And you're going to see all the OEMs start to put this self-driving in their cars in different ways. So it's really underpenetrated. Mobileye is the only pure play on this. So Tesla obviously is in the autonomous, rides for taxi services, just starting to roll out. Google we think is nicely ahead. So of the two at this point, we would prefer Google. But the Tesla made some really interesting comments on their call. Basically, they think the robot, Optimus, will be the biggest product ever. That should be interesting. And the keys to this is the dexterous of the movements of the hand is what's critical for these robots. So what's critical for that is the hand, the AI scale up to have this roll out in a big way. So over time, this could be a really large product for the markets. We don't like Tesla, but based on the valuation currently, it always gives us a shot to buy back into it. But we think that this is a really interesting product over the long term. Now, you'll also see the autonomous driving in Austin and other markets by year end start to roll back so they can just do it without anybody else being in the car. So no safety driver. And then Tesla has a AI chip that will complement or take some of the needs away from what they're doing with NVIDIA. They're still committed to using NVIDIA as their main supplier, but they have their own chip. So some of that market share is slowly going to diminish, I think, for NVIDIA, along with the other guys that are nipping at their heels. Texas Instruments reported. Okay, so we were waiting on this. So we were waiting for them to stub their toe a little bit, and it happened. So we're getting a shot at the stock, really high quality stock. So what's going on? This is a cyclical play on semiconductors. So they're saying that it's a slower pace of a cyclical recovery than prior cycles. Well, the Fed's still being pretty restrictive in terms of the interest rates and getting the rest of the economy moving. So as rates come down, their end markets are going to pick up. Not that they had a bad revenue growth; they were up 14% year over year. And some of these sectors that they sell into, like industrials, up 25%, enterprise up 35, communications up 45, and their AI area that their AI business was up about 50%. So it's about 10% of the overall revenue growth, and they're going to start to break that out. So Texas Instruments is slowly going to become this AI play, in our opinion, but with a cyclical recovery happening to it. So the pullback in the stock's given us an opportunity here. And we think as they go through next year, we think that the guidance is very conservative currently for the fourth quarter, and we're going to see a nice pickup as we go through next year. We have a $275 target on roughly $170 stock. So this one has got a ways to move up. And you can see it's gone sideways for the last 12 months. Here's a buying opportunity right here. So we like this stock, and we added it to our portfolios. Intel's turning. I can't believe they reported a positive earnings estimate. So as you remember, we were all over Intel when it's 20. Now it's pushing 40. So I love this new CEO. I think he's really bright. He's got the right strategy in place. I was pretty fired up, listening to their conference call. So they're gonna use their x86 platform to roll out their AI. So as we mentioned a week or so ago, talking about computing on the edge, this is what it is. So Intel is going to slowly get into the AI space by providing that service to outside the data center. So, they're having a relationship with NVIDIA, and I think that's really positive for the stock. If you take out Foundry, so Foundry lost over $2 billion. Yeah, $2 billion in the quarter. So that's equal to about $2.50 per share annually. Okay, if you get rid of those losses or you close it down, but the plan is to get rid of those losses over time, you're looking at probably a $3.50, $4 in earnings. So you put a 20 times multiple on that, you got an $80 stock and the stock is below 40. So kind of interesting. We would like to buy this maybe 30 or less, but we already own it at 20, so we're on for the ride at this point. The financials, so some of the reports there, I'll highlight COF, Capital One, blowout quarter, 595 in earnings, looking for 438. Margins up nicely, credit loss is stable. They announced a 16, I should say, billion share dollar, $16 billion share repurchase program. So that's over 10% of their outstanding stock. Um, so if they got the same multiple as American Express, and it'll take a while, we see a doubling in the stock price. So not only do you get nice earnings growth going forward, much faster earnings growth than you're going to get out of American Express, but you also pick up the PE multiple expansion. I really like this. I know I've been talking about it for a while. I can't stand anymore. I got to own some stock here. And so this is my 3 to 5 year sort of holding. This is going to be a good one. Now, chemicals. So we talked about Dow Chemical last week. So they reported a better than expected quarter. So the chemical industry is in a long down cycle and capacity is being shut down. We think 10% of the capacity in the chemical area is being shut down. So that's very positive for the earnings for Dow Chemical, as an example, which is a low cost producer. So the industry is being rationalized, and we can see earnings estimates going back for this basically flat currently, but going back to maybe $8 or higher per share and putting a 10 multiple on that. So the cash flow of the company looks actually pretty good now. The company's lean and mean. I think everything's going in the right direction. It's in a very early stage of very nice recovery. We're going to need like the housing market to pick up and China to improve, rates coming down. But I think this is a really nice position owned, deep value position in a high quality company. The industrials, Honeywell reported. Okay, so Honeywell reminds me of GE, back when they started to spin out their different subsidiaries. And GE's done great. All their subs have done really well. So they're spinning out three independent public companies. The first one will be the Advanced Materials, and that'll be on October 30th. We'll take a look at it. That might be an opportunity. So Honeywell had order growth of 22%, really strong. So you can see some of these early cycle companies are starting to kick in the gear as we've only got one rate cut recently. And so they're starting to kick in the gear. Think if we have three more in front of us and the QT going away, you're going to see business momentum, the economy pick up, and these type of stocks do really well. So in the short term, we don't like the valuations of the market. We think the market is melting up, which means it's going to have to rotate to everything else. And so we're playing that final rotation. And then I think we're going to get a pretty large pullback at some point in time. If all the news goes well this week, We think the market continues to go higher. You're going to have portfolio managers chasing performance through year end because most money managers have lagged. No one can own 8% of NVIDIA in a portfolio. So, people have lagged the overall markets, and I think there'll be a lot of chasing of performance and it should gravitate higher. We're concerned about the valuation and we're watching very closely how the market behaves, and we're ready to get defensive when we need to. Thank you very much. If you have any questions, come to my website, Patrick Adams CFA, ping me, and also sign up for a hard copy of Market in a Minute. We'll sign you up for that. And if you need anything, any sort of money management services, come to PVG Asset Management. Look at our strategies. We got great strategies, mostly tactical strategies, and an incredible emerging healthcare strategy. Take care.